with Ohana Investment Partners, and I help people like yourself passively invest in real estate. And so my goal is to provide you with educational resources so you can grow your knowledge, so you can make an informed decision about the best passive investing options and offerings in real estate. So today we are going to talk about multifamily lingo. So there is in commercial is so different than real estate. There's a lot of different terminologies. So it may feel overwhelming in the beginning, but don't let that hinder you. It's honestly very straightforward. I think multifamily commercial is much more straightforward than residential. So don't let that hold you back. I applaud you for watching this and learning some of this stuff. So we'll go ahead and get started. Okay, multifamily lingo. What are we even talking about? Again, in the multifamily or commercial world, and when I say multifamily, I usually will say multifamily or commercial. So the definition of that for multifamily to fall under the commercial umbrella is for there to be 5 or more doors on one parcel. So that's when I say multifamily, that's what I'm referring to. The faster you learn the lingo, the more it's going to make sense. When you get offerings, if you decide that you want to passively invest in real estate, you're going to get offerings, right? And so you're going to get from myself, maybe from some other people you've contacted, you're going to get opportunities, and you should take the time to be educated in the beginning so that when those opportunities or those offerings present themselves to you, you're ready to go. You're ready to pull the trigger. You know what does and does not meet your goals, because one of the most critical things you can do is to clearly define your passive investing goals. It's like anything else. It's like your business, your life, right? You want to make sure you have clearly defined goals. Okay, multifamily math. So this is, and bear with me, it's not a lot of math, but there is some math that goes into multifamily, because everything in multifamily or commercial is based on the financials. So we have to look at numbers. You have to look at the financials. So you'll see here some of the equations that are commonly used in the commercial world. So your purchase cap rate should be higher than the market cap rate. And so we talked about cap rates in the last webinar. Your purchase cap, if your purchase cap is higher and your market cap is lower, that means you're buying in essence below market value, right? So you're buying with some equity. Valuation formulas. NOI is your dollar amount per year, right? It's a dollar. Your NOI is your revenue minus your expenses. Now, this does not include debt service. Again, this does not include debt service, which means it does not include the mortgage. You're just looking at revenue minus your expenses. Your cap rate, or your cap, it's a percentage, is your NOI, your net operating income, divided by the price that you're paying, or the price that you paid. Your value is your NOI, or your net operating income, divided by the market cap rate. That's the value of your property or your asset. So we call properties assets a lot in multifamily. The cash flow is it's in a dollar amount, right? And it's done annually, typically. It's your NOI, your net operating income. Remember, that's your revenue minus expenses, minus your debt service. So remember, net operating income, you do not include debt service, and cash flow you do. So you want to take a look at what is your NOI. So your cash flow in essence is your revenue minus your expenses minus your debt service or your mortgage. Cash in the deal is the amount of money you are coming to the table with, right? It's your down payment, it's your closing costs, your rehab costs, your syndication fees if you're syndicating, your broker fees. It's all the money that you are bringing to the table at close and putting it, right? And including CapEx, right? So capital expenditures. Your cash on cash return here, it's cash flow divided by cash in the deal. So remember, your cash flow takes out your mortgage, right? So it's revenue minus expenses minus your debt service. So you're going to take that number and you're going to divide it by cash in the deal, which is the money you brought to closing plus any capital expenditures. That's your cash on cash return. And that number is typically in 8% because it's a return. Okay. So your cap rate is the rate at which the NOI, or net operating income, pays off the purchase price on an annual basis. So everything in multifamily and commercial world is done on an annualized basis. Your cap rate, again, is your net operating income divided by the current market value. Here are some average cap rates, and I say average cap rates because it really depends on the market you're in. That's why you really need to do some research to understand what is the market cap rate, right? So these are roughly about what they are in Orlando. So you can see this is about what they are. I'm in Orlando, but average cap rates, right? Class A is 3 to 5%. Class B is 4 to 6%. Class C is 6 to 8, sometimes a little bit higher, and Class D is 10 and up. Okay, so those are your average cap rates. But what the heck do we mean by Class A, B, C, and D? So we're going to dive into this a little bit so that you understand. Class A properties, they have a luxury feel. They're premier or premium properties or assets. They're, of all the classes, they're by far the most expensive per unit. So if you're paying, you know, $1 million, that may be for 4 units. That may be for 5 units, right? Or if it's Class C, you may get 10 units for that. Likely not like 10, but most expensive per unit. They're newer build and the most modern. So they're typically built within the past 10 years. Or they've been really extensively renovated if they were built prior to that. They're high quality construction. They're more modern. They're in amazing locations, excellent locations, and they have amenities. So if you think about these properties, they're the ones with the clubhouse, with the pool. They may be gated. These are Class A properties. Class B properties typically have more middle-class tenants. They're constructed within the past 15 to maybe 30 years. They may have a little bit of deferred maintenance, but they're still really good quality construction, modern construction. They're located in stable neighborhoods. And they have some amenities, not a ton. Class B is very recession proof. Class C is constructed within the last 30 to 50 years. These often tend to be a little outdated and may have deferred maintenance. So they may need some capital expenditures. They may need to be remodeled. There are limited, if any, amenities. So they may have, you know, 1 or 2 amenities, something basic. They may have a pool. They may have Wi-Fi, you know, but they likely don't have garbage valet and covered parking or garages and things like that. They're typically also in a stable area, and typically they get really good rental rates. There's an average vacancy, and these are historically blue-collar tenants in a blue-collar, very middle-class neighborhood. These are great properties or assets for value add, where we can go in as operators and we can take care of the deferred maintenance. We can put in professional management. We can do a lot of things to bring the value of the property up to force appreciation. So these are also great assets because there's a little more deferred maintenance and a little more quote unquote value add to be done. They're a little bit more risky than Class B. Class D. These are the roughest properties in the roughest neighborhoods. They are high crime, and you can find the crime data on ADC or ADT.com. I think it's /crime. Crime Spot's another good place to look. They're constructed in the last 30 to 100 years. They typically either have poor construction with poor materials or are just very run down. Very poor condition. They're typically in a quote unquote war zone, and they have no amenities, 0. So if you are at an asset or property at night and you feel uncomfortable and you don't want to get out of your car, this is probably a Class D asset. Some people like Class D, some people do not. We do not buy in Class D. We don't buy Class D assets, and we don't buy in Class D areas. Some people do. If that's something you want to do, or that's something you want to invest in, I think that's great, right? You have to make sure it meets your goals. But whether you're an operator or an investor, sometimes the property management on these will be much higher because the property managers literally have to go fight for the rent, right? They have to go get it. And some property management companies will either charge a premium or they will not cover these at all. So that's a good question to ask, whether you're an operator or potentially investing in these areas, to figure out, you know, what are they doing for property management. IRR is the internal rate of return. It's another word for total return, and it's or the annualized percentage return. So it includes all the returns to the investor, to you if you're passively investing, over the term of the investment. And this typically involves a somewhat complex calculation. It includes appreciation, it includes cash flow, it includes principal reduction of debt, and some other things. So that's your internal rate of return. And again, I know I'm going through these a little bit quickly just because we have a lot of information to cover, and I try to keep it within 20 minutes. But if you have questions after this, you can reach out to me, or you can pop them in the chat as well. Happy to answer them. You will also get a copy of this recording. Preferred return. If you are a limited partner, if you're lending into a syndication, you will be a limited partner. And as a limited partner, the investor is the first to receive returns. So that's called a preferred return. This is typically stated as an annualized percentage rate. So if you're getting a 6% preferred return, that's annualized, right? That's over the course of the year. Or sometimes you'll hear a 6 pref or a 7 pref, right? Or 5 pref. Equity multiplier is the cash distribution from the investment. So an equity multiple of 2, if it's a 2x equity multiple, that means you're going to double or 2x your money over the term of the offering. If it's a 1.9, so right now I'm working as a fund manager and I'm raising for a 506c accredited investor offering. So if you are an accredited investor, circle back with me after this webinar. But it's a 1.87, so if you round up, right, 1.9 equity multiple. So this means if you're investing 100,000 at the end of the term of the offering, which for this one is 5 years, you're going to have $190,000, right? You're going to get your initial investment back plus $90,000. So that's what an equity multiple is. Annualized return. This is calculated over the life of the investment. This is a pretty simple calculation. You're taking the ROI, or the return of investment, and you're dividing the number of years to get your average return. So these are your annualized or your average returns. Cash on cash return. You're looking at what your cash flow is and you're dividing it by all the money you have into the deal, right? So again, that's going to be your closing costs, your brokerage fee, your CapEx, which is capital expenditures, which would be any deferred maintenance, any, roofs, interior remodeling, things like that. So you take your cash flow and you're dividing it by all the money you have into the deal. That's your cash on cash return. It gives you a really good figure, a very good, accurate figure on your return. So it's a good indicator. It does include debt. So this does, I know some calculations include debt service, some do not. This one does. Operating expense ratio. Some people say OER, some people just say expense ratio. It's your operating expenses divided by your gross income. So you add up all your expenses and you just divide it into the gross income. So these are your gross rents. If you have any late fees, pet fees, right, it's gross coming in before any expenses. Typically, we see a 45 to 50% expense ratio, depending on the area. So you may see a 50% expense ratio, especially for Class C if it's older. You may see less if it's Class A because it's newer construction, it's newer builds. You're not going to have a ton of expenses as far as deferred maintenance and things like that, so maybe lower. I'm sitting in a hurricane zone, right? I'm in Florida, so we typically run expense ratios at 50%. Please note though, if you're looking at mobile home parks, we just bought a mobile home park. Typically the expense ratios for those run between 38 and 42%. So it is different because the overall expenses for mobile home parks are less than they are for multifamily or commercial. LTV is loan to value. Loan to value is the mortgage amount divided by the property value. It's simply the ratio of how much the banks will lend based on the value. So you can expect a bank loan to cover typically 70 to 80% of LTV on average, right? So they're going to cover, let's say they're asking for 20% down, right? They're covering 80% LTV. So they're covering 80% of the loan to value. I know when we closed on the mobile home park, we had to bring 25 down. They covered 75% loan to value. DSCR is debt service coverage ratio. This is your NOI, which is your net operating income. Remember, this does not include debt service. So it's your revenue minus expenses, and then you're going to divide this by your debt service payment. So this is used by lenders, and it's used by lenders because they want to make sure you can cover your loan payment. And when I say you can cover, they want to make sure the asset can cover its loan payment. So when you're in the multifamily and commercial world, the asset should pay for itself. Banks check the percent of NOI remaining after the mortgage is paid. That's really important. So if the DSCR is less than 1, the asset cannot pay for itself. If it's over 1, the asset can pay for itself. So lenders typically look for a DSCR equal to or above 1.25. And that may vary a little, but that's a good rule of thumb. Cash flow. Cash flow is your money remaining after your property expenses and your mortgage or debt service every month, right? It's cash flow is after everything has been paid out. What do you have left? Appreciation. Appreciation is typically quote unquote forced with a value add property or in commercial investments. It is forced because that means the operators have more control over the value. They have more control over the appreciation. They can make improvements to increase the value of the asset through physical updates or increased economical efficiencies. So what is an increased economical efficiencies? That means actually getting rent paid on time. So if you have an economical vacancy, it means someone's not paying their rent, someone's living there, or maybe they're paying their rent late or paying a portion of it, right? So you can make improvements, you can force appreciation by potentially remodeling, by increasing the rents to market rents, by making sure you're capturing all the rents, by charging a late fee, by if there's covered parking, you can charge for covered parking. For some Class A properties, they will do valet trash service, right? They can offer Wi-Fi, they can offer an amenity package. You quote unquote force appreciation when you increase the income and or you decrease the expenses, right? So at the end of the day, your NOI is increasing. When your NOI is increasing, your value is increasing, and you as an operator have control of that. If you are not an operator and you're a passive investor, it's a great question to ask. How are you planning to, what is the business plan for this asset? Excuse me, how are you planning to increase the appreciation? So you take your NOI, right, and the change in your NOI is going to go up. You multiply that by the cap rate to see how much value you just added to your asset. I know recently in a newsletter that I sent out a couple weeks ago, we increased rents by about $300 a month for one of our mobile homes. That forced the appreciation of our mobile home park by $40,000. This was one unit. It is significant. This is one of my favorite parts of multifamily or commercial world. It's magical. It's truly magical. Tax advantages. As an owner or as an investor, you get to deduct interest, insurance, maintenance, and depreciations. So those tax benefits, those tax advantages are passed through to you as an investor. Obviously, if you're investing through a retirement account that is a non-taxed situation, it's different, right? But let's say you're investing with cash, that is passed down to you. So a lot of people are looking to reduce their tax burden. Passively investing in real estate is a great way to do that. If there's a cost segregation study, or you may hear a cost seg being done, then you're going to have more tax write-offs, because in essence, it's accelerating the depreciation. So instead of taking a straight line depreciation, you're looking at separate assets and you're depreciating them. If you're interested in passively investing in real estate, it is a great way to grow your wealth. It's something I am very passionate about, and something that we have done in our family. My goal is to get that out to as many families and as many people as possible. So if you're interested in becoming a passive investor, you can sign up at ohanainvestmentpartners.com/invest. And there is never any obligation, there's never any pressure. But even if you think this is something you may be interested in, I encourage you to go ahead and sign up as an interested investor. What this is going to do is you're going to start getting offerings, and you can start going through them and really start getting comfortable with the presentations, with the webinar, with the terminology. So you're going to see some of the terminology and some of the lingo that we went through today. You're going to see that in practice and in real world, and you're going to really start understanding it. So it's really where the rubber meets the road. I saw someone ask a question. Okay, hold on, I'm gonna stop the recording. Oops.